Chapter 9 we covered already. Let's close that and we go to chapter 10. So here is chapter 10. And here are some exercise. So let's do problem 1, I think. Oil company provides various services to the operators of North Slope oil field in Alaska. Data concerning the most recent year appear below. They had sales of $7.5 million. Net operating income was $600,000. Average operating assets are $5 million. Compute the margin of company, compute the turnover, and compute the return on investment. Okay, so we have the data. All you need to do is just do some math. So margin is net operating income divided by sales. Margin, or so-called profit margin, is operating income divided by sales. And that gives you a percentage. So operating income is $600,000 and sales was 7.5. So the profit margin is 8%, which is good to know, right? But we like to know also the turnover. The asset turnover means how much of every dollar of asset has been turned over into sales. So the formula is sales divided by average operating asset. The reason we do average operating asset, it is obvious because sales is for the whole year, right? For the whole 12 months. You cannot just say, what is my asset at December 31st? You have to say, what is my average of asset for the whole year? So average of asset for the whole year compared to the sales of whole year, that's an apple-to-apple comparison. And so sales divided by average asset. Average asset is December 31st of last year balance sheet asset plus December 31st of this year balance sheet asset divided by 2. So the sales divided by average operating asset gives us 1.5 times turnover. That means every $1 of asset, operating asset, turned over 1.5 times of sales, generated 1.5 times of sales. So now you want to know what is return on investment. Return means profit. On investment, that means average operating asset, right? So return on the investment of asset. Return on the investment of asset. So return is the first word. Investment of the asset is average operating asset. Second word, that goes at the bottom. So return divided by asset. Return divided by asset. So that's net operating income divided by average operating asset. And that gives you the return on investment. The other way to calculate return on investment is having a margin, profit margin, multiplied by turnover. Multiplied by turnover. And you can see why that's true, because look at the margin. Net operating income, right? Divided by sales. And then the other one is sales divided by average asset. So if you multiply these two, the sales at the bottom with the sales at the top, they will wash out. So what will remain is just net operating income divided by average operating asset, which is the same as ROI, return on investment. Return at the top, investment at the bottom. Return divided by investment. So that gives us 12%. So return on investment is 12%. Why is return on investment important? Because every company has a weighted average cost of capital, or hurdle rate, or minimum required rate of return. That means every company, based on the 2 ways that they raise capital, by issuing stock or borrowing, equity financing or debt financing, they have a cost. Nothing is free. So weighted average cost of capital is whatever the cost of equity is, equity financing, and what is the cost of debt financing. Add them up, that's the weighted average cost of capital. So whatever it is the weighted average cost of capital for every single company, return on investment should be higher than that, at least equal to that, if not higher, right? So that's very important to know what is the return on investment, because if your cost is, let's say, 10% and your ROI is 12%, that's good, because your cost is 10%, but you are generating 12%. Very good. So your profit is good. But if your weighted average cost of capital, WACC, W-A-C-C, if your WACC is 10% and your ROI is 9%, that's horrible, because you're not covering your cost. You have to have at least cost or above cost. So weighted average cost of capital, if it is 10%, then your ROI should be either 10% or higher. Okay, that's number 10. We got enough information on that. I would like to do one more. Here is, let's look at the problem first. Number 2. It says company had net operating income of $600,000 of sales of 300. So 600 out of 3 million, that will be your ROI, right? The company's average operating asset for the year, oh no, that's 600 out of 3 million, that is your profit margin. The company average operating asset for the year was 2.8 million. And its minimum required rate of return, which is WACC, weighted average cost of capital, hurdle rate, it's 18%. 18%, that means the minimum rate of return the company needs to generate. The cost of capital, that means equity financing plus debt financing, is 18%. So the company needs to generate at least 18% just to survive. Compute the company's residual income for the year. Okay, let's do the math right there. So average operating asset is 2.8 million. Net operating income is 600,000, right? So minimum required return is 18% of 2.8 million. That means they have to generate at least $504,000 minimum. So anything above that will be extra income or so-called residual income. So our residual income is $96,000. If you like to know, let's say, what is ROI? ROI is return on investment. Return is the profit, which is 600,000 divided by investment of 2.8. So 600,000. Let me calculate. 600 divided by 2,800. That's 21.4. 21.4% ROI, right? So 21.4% ROI, and the minimum required rate of return is 18%. So the company is doing much better. How much is the residual value technically? From the dollar amount point of view, it's $96,000. Okay. Let's do number 3. I like to do few so you can get some idea of what's going on in the chapter, okay? And most of these things that I'm doing is in your homework. So I'm helping you on that too. Here we go. Let's do one more, please. Okay, so the company would like to reduce amount of time when a before we do this, I like to see if I can Google it so you can Google later on. VAC or weighted average cost of capital. So here, so weighted average cost of capital, that's what we call it, minimum required rate of return or hurdle rate. And if you like to read about it and get some more idea, obviously there are some good links in here. The weighted average cost of capital or minimum required rate of return or hurdle rate is the average rate that the business pays to finance its assets. The financing comes either from equity financing or debt financing. The combination of those two will give you a weighted average cost of capital. You learn to calculate that in a finance course, okay? It's calculated by averaging the rate of all the company's sources of capital, both debt financing and equity financing, weighted by the proportion of each component. So in that case, when it says proportion of each component, because when you do debt financing or equity financing, normally you don't do 50-50. You maybe do a little bit debt financing and the rest equity financing. So that weight is a little bit this way or the other. But you get the weighted average cost of capital, then you know what the cost is, and then you know how much you have to have at least return on investment, okay? So hopefully you got that idea of it. Okay, now let's go to the problem 3. I like to cover this area too, so you can get a better idea about this chapter 10. Management of a company would like to reduce the amount of time between when a customer places an order and when the order is shipped. For the first quarter of operation during the current year, the following data were reported: inspection time, wait time, process time, move time, and cool time. Compute the throughput time. Compute the manufacturing cycle efficiency for the quarter. What percentage of throughput time was spent in non-value added activities? Compute the delivery cycle time. If by using lean production, all cool time during production is eliminated, what will be the manufacturing cycle efficiency, MC? Okay, so let's do it one by one. We have the data here available, and I would like to see if I can show you the problem. So the throughput time equals process time plus inspection time plus move time plus cool time. So 2.7 days is the process time. Inspection time is 0.3 days. Move time is 1 day, and cool time is 5 days. Cool time is the time that normally you lose in between of all this process, those wasted time. So process time plus inspection plus move time plus cool time gives you 9 days. So the throughput time is 9 days, right? Throughput time is 9 days. Okay. Only process time is value added, right? This part, only process time is value added. The rest, it's not adding any value, specifically move time or cool time. Therefore, the manufacturing cycle efficiency is value added time divided by throughput time. So value added is just 2.7 out of 9 days. So efficiency of this process is just 30%. The rest is literally wasted. If the manufacturing efficiency is 30%, then 30% of throughput time was spent in value added activities. Consequently, the other 70% of throughput time was spent in non-value added activities. Make sense? Delivery cycle time. The delivery cycle time is the wait time from the moment they receive the order, plus the throughput time from the moment they start the manufacturing and delivery. So the total is 14 days wait time plus 9 days throughput time is 23 days total delivery cycle time. If all quote time is eliminated, then the throughput time drops to only 4 days, right? So if we can manage to delete this quote time, then the throughput time will be just 4 days, right? Okay, that will, just by doing that, that will increase the manufacturing cycle efficiency to 67.5%. That is a significant increase in the efficiency of business operation. Therefore, manufacturing cycle efficiency increases to 67.5%. This exercise shows quite dramatically how lean production can improve the efficiency of operation and reduce throughput time. Good. So you got an idea about chapter 10. It's a very interesting chapter. There are a lot of calculations like return on investment and residual income. And when you want to have a judgment on your operation, you have to look at the return on investment and residual income in the same time, okay? Because sometimes investment, they might have less return on investment, but eventually they have some residual income. You don't want to eliminate that option, okay? So take that work if you see sometimes the return on investment in some jobs are lower, but take it because you have some residual income anyway, right? And don't judge your managers just on return on investment, but also judge your managers on residual income. Because if you just judge your managers on return on investment, they might turn down some of those projects that they have lower ROI, while they ignore the fact that they have residual income. Residual income is extra money. You don't want to let it go. So don't blame your managers or say, oh, because your return on investment overall came down, I'm going to cut your bonus. No. Consider this. Return on investment came down from previous period, but residual income went up. So give them the bonus. Make sense? This is the management way of thinking. So judge properly and treat your managers properly so you can get higher residual income while you are trying to maintain your return on investment. Make sense? Thank you so much. If you have any question, please take your time to see me on my office. Problem questions regarding that chapter that I'm covering. Okay, thank you.